In this video, we're going to look at Cenovus Energy, and this is an oil and gas company located in Canada. And I'm going to look at the stock trading on the Canadian Stock Exchange, the Toronto Stock Exchange. And what I do in my videos is I figure out the real value of a stock looking at the company's financial information and capital structure. I also look at the financial ratios of the company and compare them to its competitors. So let's get started with the model. So this company has a market cap of $7.82 billion. Canadian dollars, that is. That's the value of the company according to the stock market. And let's see what it's trading at. It's trading at $6.36. So one share is $6.36. And next we're going to look for the free cash flows. These are the actual cash flows the company generated. Free cash flow means cash that's left over after expenses. And this is how you want to look at a business, is you want to value their company based on their free cash flows, because this is how you make money with a business. You generate cash, and this is how people get paid, their investors, their employees. If there's no cash remaining after your operating period, you don't have much of a business. Net income is important too. That's the profit and loss according to the income statement. But if that's positive, that might not necessarily mean you're generating positive cash flow, because there's accrual accounting and there's non-cash items in an income statement. Now I'm going to pull the revenue from the income statement. This is the sales for each year. And look at that. Their revenue doubled from 2016 to 2019. That is really impressive. Free cash flow was negative in 2016, and in 2018, it was $700 million, then it tripled to $2.1 billion. So it's kind of all over the place, this company. They also have negative net income one year, then positive, then negative, then positive. So hopefully we can get a good value for the company. Sometimes when the numbers are volatile and inconsistent, it makes it really difficult to value. Let's figure out the capital structure of the company to see how much we have to discount the future cash flows by. Their interest expense is $489 million. That's the interest they pay on their debt. That's on the income statement. Let's see how much debt they have. We'll go to the balance sheet for that and go to the liability section. Current debt, no current debt. Long-term debt of $6.7 billion. That's debt due after 1 year. And it looks like they don't pay taxes according to their income statement. So the cost of debt is 7.3%. That's a pretty high interest rate. If somebody pays a high interest rate, whether that's an individual like yourself or a company, that generally means they're not good creditors. They're very risky investments. Let's look at the volatility of the stock, and you'll see why. They have a beta of 3.48. I think that's the highest beta I ever seen. That means the stock moves 3.5 times of the market. It can be considered a risky investment when you invest in a company with such a high beta, because the stock's bound to move all over the place in wild gyrations, which also means the weighted average cost of capital, the discount rate, is going to be high as well. We need some more information from the balance sheet, because we're going to look at the ratios of the company at the end. So let's go to the balance sheet and get their current assets. These are assets which can be liquidated into cash within 12 months. And it includes cash, accounts receivables, and inventory. And let's get their current liabilities. That's $2.5 billion. And let's get their equity. That's total assets minus total liabilities, and that's the value of the company according to the balance sheet, $19.2 billion. And the EBIT is earnings before interest and taxes, or operating income, and that's on the income statement. That's $1.7 billion. This is how much money the company generates from its operational business, but before it pays interest on its debt and before it pays taxes. So you see the weighted average cost of capital is a blend of the cost of debt, 7.3%, and they have 26% debt, and that's combined with the cost of equity, 29%, and they have 74% equity in their capital structure. And we figure out the cost of equity using the capital asset pricing model. And when you combine the cost of debt and the cost of equity, you get the weighted average cost of capital of 23.5%. And that's what we're going to use to discount the future cash flows by. So we estimated 4 years of future free cash flows. We did a terminal value, which is all years past year 4, We discounted those numbers to today's dollars, and we get a value for the company of $35 billion. We divide that by 1.2 billion shares, and we get an intrinsic stock price at $28. It's trading at $6, so it's trading at a 78% discount. So it's a buy according to the model. Let's see what Simply Wall Street values the company at. They value them a little lower at 22 Canadian dollars. So we're both in the same ballpark with our valuation. Mine's a little higher than theirs, but like I said, when a company is so volatile, it can make it a little difficult to value the stock. Let's see where the stock has been trading historically. It looks like it was trading in the low 20s 4 or 5 years ago, but it's dropped quite a bit for a number of years, and then when coronavirus hit, it dropped even more. It's come back up a little, so it appears to be a good value at this point, but who really knows? It's hard to estimate the future of a business. We're trying to figure that out based off of the past. Now let's look at the financial ratios to get more information. Great PE, 3.6. That's price of stock over earnings per share. That means investors are willing to pay $3.60 for $1 of earnings. Really good price to sales ratio, 0.4. That's price of stock over sales per share. So investors are willing to pay 40 cents for $1 of sales. You might say, why would anybody sell $1 of sales for 40 cents? It seems too good to be true. Because price to sales is a good ratio to look at, but unless you can convert those sales to profits, it doesn't really mean much. Price to book is also really good at 0.4. That's price to stock over book value per share. They have a good current ratio of 1.3, so they can cover their current liabilities. ROE of 11%, that's income over equity. That's a little lower than what I prefer. Interest coverage ratio of 3.6, so they can cover their interest payment 3.5 times, so they're doing okay there. And they're low in debt at 26% debt. The best way to look at ratios is to compare them to similar companies. So I've done videos on Husky Energy, which is another Canadian company, Suncor, and Exxon, which are both American companies. So the ratios you can compare, it's just the market cap is in the country's dollars. So these two are in Canadian dollars and these two are in US dollars. If Cenovus has a number in green, that means their ratio is better than the average. If it's in red, that means it's worse than the average. So we see a lot of green, which is a good sign when you're investing in a company. Cenovus has the best price to earnings ratio of 3.6. The average is 5.6. So all the companies are doing well in price to earnings, except Husky. It's negative because they have negative earnings. Price to sales ratio, all the companies are really low. Husky is the best at 0.2. Price to book, all the companies are also really low in that category. Husky is the best at 0.3. Current ratio, only Husky and Cenovus are able to cover their current liabilities. Suncor and ExxonMobil are unable to. And that's generally not considered a good sign, or it could just mean they're really efficient with using their current assets. ROE, none of the companies have a good ROE. Cenovus is the best at 11%, but all the companies are on the lower side. Debt, none of the companies use too much debt to finance their business. And in terms of market cap, Cenovus is 7.8 billion Canadian dollars, and Exxon, of course, is the largest of the four. So let me know what you think in the video. Do you think there's other ratios I should be looking at? Thanks for watching.